Hi guys, welcome to Stacking Stocks, and thank you for joining us today. Today's session will be interesting as always since we'll talk about NIO's plan to introduce 3 new electric vehicles in 2022. With that said, do you think NIO stock is a buy now? How will the introduction of new EVs impact the company's sales? Let's find out. China's NIO continues to see strong demand for its luxury electric SUVs while innovating battery technology and growing its lineup of electric cars. Is NIO stock a buy right now? We'll discuss several factors, and after that, you can decide whether or not you think it's time to buy NIO stock. Nonetheless, we believe that NIO has come a long way. Founded in 2014, NIO had little experience in vehicle manufacturing when it came on the scene. Of course, some people ruled it out then, but the electric vehicle startup displayed a promising future. Many years later, we're talking about a giant EV company with good growth. Don't you think this is beyond amazing? NIO continues to grow EV sales after more than doubling them in 2020. Furthermore, can you remember the company was at the brink of bankruptcy in 2020? NIO managed to survive that unfortunate situation and has been revamping its production since then. Even though the company faces rising competition from Chinese tech and auto giants, besides Tesla, the global EV leader, we believe that the company will rise to the occasion and produce great returns. There is hardly any industry where booming startups have it easy, but we still get to witness excellent results beyond anticipation. What we're trying to say is that NIO won't slow down operations because of competition. We anticipate fully electric and hybrid EVs to make up 90% of new car sales in China by 2030. That would be up from about 10% in March, suggesting ample room to grow. What does this mean for the Chinese auto market? It means that electric vehicles are the future of transportation. Manufacturers as well as consumers should buckle up and be ready to embrace zero-emission vehicles. As much as it's good for the environment, there's also a need to embrace change and technological advancement. Are you wondering why we're discussing this? When consumers adapt to an EV-oriented auto market, companies like NIO are set to get much more attention than it's getting at the moment. What we're saying is, NIO is the future. That means that investors should also start considering NIO stock. Let's have a look at NIO's plan for 2022. NIO plans 3 new EVs in 2022, including the ET7, its first electric sedan. The blooming Chinese startup already makes 3 premium electric SUVs, including the ES8, ES6, and EC6. The company looks to add to its already luxurious collection. We believe that the EV company will massively boost its sales with the introduction of new EVs. But then we also think that certain factors might scare investors. For example, NIO lags on key earnings and other fundamental metrics. We understand that it's a young and fast-growing company still looking to turn a profit, but such factors influence investors' stock sentiment. Would you invest in a company posting poor results? We believe that NIO's lag in key earnings and fundamental metrics will be the company's undoing. Let's assess the company's performance in terms of figures and numbers. NIO stock earns an EPS rating of 47 out of 99 and an SMR rating of D on a scale of A+ to a worst E. The EPS rating compares a company's earnings growth versus other companies. The SMR rating measures sales growth, profit margins, and return on equity. As you can see, the figures are not appealing. Compared to other companies, NIO stock is lagging in terms of earnings growth. The company's rating is even worse. We can see that NIO is way behind in profit margins, sales growth, and return on equity. In August, NIO's EV sales rose 48% year over year, but they fell 26% month over month. We established that NIO's supply chain and EV manufacturing were affected by the pandemic in China, thus the poor results. With such results, NIO will have a hard time catching up with its rivals, who outsold the company in August. Let's have a look at NIO's figures. On September 1, NIO cut its Q3 EV delivery outlook, citing volatile semiconductor supplies. NIO more than doubled EV sales despite the chip shortage in Q2. For its fiscal second quarter, NIO delivered a narrower than expected loss. NIO lost 3 cents a share, while revenue soared 145% to $1.31 billion. Investors should expect NIO to pare losses to 50 cents per share in all of 2021 from 73 cents in 2020. We could also see the revenue surge by 123% this year. Amid stiff competition, NIO is speeding up new EV launches. It aims to deliver 3 new products in 2022. These include the ET7, a premium electric sedan, and NIO's most technologically advanced vehicle yet. It also plans a new mass-market brand. However, China's crackdown on data collection is weighing on Chinese stocks, including NIO. Increasingly smart electric vehicles will generate lots of data. New regulations on managing and securing automotive data, which took effect October 1st, require in-vehicle processing and no collection by default of data. With such restrictions in place, NIO might have a hard time through the ranks, but that doesn't mean that the company should not push itself over the edge to increase sales. We've established that NIO is expanding capacity in China while launching its first overseas sales in Europe. We also know that it's set to begin ES8 deliveries in Norway this month. The ET7 goes on sale in Norway and Germany in 2022. Peers BYD and XPeng are in Norway as well, with Li Auto also planning to enter the European market. Chinese EV makers are challenging domestic counterparts and Tesla on the continent. We expect China's EV sales to rise more than 30% to 1.8 million. We also expect EV sales to rise in 2021. However, the global semiconductor shortage could foreshadow an EV battery shortage. Like Ford, General Motors, Tesla, and Volkswagen, NIO is also a casualty in the chip crisis. Do you think the company will manage to get through this situation? Growth drivers for NIO include new and upcoming EVs. The fervently anticipated ET7 arrives in China's first quarter of 2022, with European sales to follow. Meanwhile, battery services are crucial to NIO's business model. From what we have gathered, NIO offers an innovative subscription plan for batteries. Basically, the car and the battery are sold separately. Users can now buy NIO EVs without batteries for a lower price and rent batteries for a monthly fee. They also can swap car batteries based on their needs. Wow, this is amazing! We believe that if the company keeps providing services to suit customers' needs, its revenue will go up. The latter will attract the attention of many investors, thus leading to a stock share price increase. We have established that NIO doubled EV sales in the third quarter, beating its own guidance despite a hit to production from the chip shortage. Well, it seems like the stock is already improving. NIO regained its title as the highest producing China EV startup, at least for September. It delivered 10,628 EVs in that month, up 126% versus a year earlier. September's total also was a big boost from 7,931 in July and just 5,880 in August amid chip woes. For all of Q3, NIO sold 24,439 electric vehicles, doubling year over year and beating its lowered September 1 target of 22,500 to 23,500 deliveries. We think that despite the several challenges the company is facing, it is performing arguably well. What do you think? We believe NIO's financial condition is improving after debt and liquidity fears slammed shares from a fundamental perspective. It has significantly pared losses while delivering huge top-line gains. Expanding vehicle lineups, entry into Europe, and battery innovations mean more runway for growth. But the EV wars are heating up as legacy auto and tech giants ramp up or get into the game. In a nutshell, the chip supply crunch is a headwind for NIO. Is NIO a buy right now stock? As much as the recent results have not been promising, the stock has the potential to shine in the future. We'll keep you updated as time progresses. Once again, many thanks for tuning in today. Don't forget to like, share, and subscribe. See you next time.